Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com. And I hope that you go to the website today, tool around a little bit. There's a lot there for you to explore, zinniawealth.com. All right, so we know that many of us, as we've saved in our 401ks and our IRAs, that's where they told us to save. So we did. And they also tell us that as age 73, or for some of you, age 75, you're going to have to start tapping into that money because Uncle Sam wants his taxes. We all know that, I hope. But once it gets to that age 73, there's a calculation that needs to be done to tell you how much money you're supposed to take out of those IRAs and 401ks. And according to this study, about 24% of people, retirees, do it wrong. And 7% of retirees don't do it at all. That's a real problem. All right. So, Sharice, have you had to help?
They learn really quick that you do it wrong, you get a big penalty.
Big penalty. That's right. So have you had people who come in and you say, you need to take RMDs, and they go, what's that? That's a problem. Or that they've done it and they've goofed it up and they got a letter from the IRS and said, you messed this up. Have you had this experience?
So a couple of times people have come in and they've heard our show, and it'd be after the fact because you have to take your RMD. When you're 73, you have to take your RMD. And you got to take it by the end of the year, by December 31st. And some people, when you're first aging in, you might be falling asleep at the wheel and you don't catch it till you're 74. You're like, oh, I got this love letter from the IRS saying, hey, you got a big penalty, and it used to be 50%. Now it's 25%. And if you pay it back in a timely manner, the penalty is only 10%. But we don't
want to do that either.
Uncle Sam any more money? No way. So we don't want to miss the RMD. And there is a first offender's appeal form, and most people don't mess it up the second time. So a lot of people who's going on their own and managing their own money, I say, put on autopilot, call these companies, set it up, have your taxes withdrawn if you want to or don't, have it come in monthly or just annually. And I, like my clients, we try to get them all to take it in the summer. And then if you do take it at the end of the year, but no later than October or November 1st, and just make sure that there's a plan for it, because there is a penalty if you forget to take it. So the age is 73, you have to take it. And if you're born after, by the way, 1960, you don't have to take it till 75. But one thing that I want people to know, which they don't like, this is what I teach in one of the little pieces I teach in our workshop, is that let's just say you are 73. And you miss it this year, you actually can take it next year, but you have to take it before, I think it's April 1st, but then you have to take a second distribution by the end of the year. So you have to take two. So if your income's high and you're trying to spread out your taxes, try to not miss it the first year. So that's one of the key indicators. But one thing people don't know is that the RMD percentage you have to take out, it's a divisor number. So when you're 73, it's about 3.65%. So if you got $1 million, you know how to do the math, figure that out. And every year that percentage goes up, 3.75, 3.85. By the time you're in your late 80s, you are pulling out 8%, and it keeps going up every year. So this is something I didn't know years ago. 20 years ago, I didn't know this. And my client's like, why didn't you do this 20 years ago, right? And that was 10 years ago. We were having those conversations. And what I mean by that is that most people, Randy, if you have $1 million portfolio, let's say you're 63, well, you want that to double. Right? Everybody wants their money to double over 10 years. That's the way it's supposed to work, right? This is what we've been taught. That's the way things work. And it doesn't always happen. Some people it does happen. So you're 63, now you're 73. Your $1 million has doubled. Now you're at $2 million. And let's say, just quick math, we had to take 4% out of that $2 million. That is $80,000. So
a big number.
You might already have $120,000 in income from other assets, pension, Social Security, right? And now you add another 80, that's $200,000. So now what we have to worry about is ugly Irma for Medicare Part B penalties. So now your Medicare Part B is not the same price as the other people next door to you. If you're age 65 and older, it could be $250, not $185. It could be up to $650. I had somebody come in there's recently, and it was $658 a month for that spouse and the husband, right? So we want to look out for those things. But now you're 73. Nothing changes in your investment horizon. You still want your advisor to double your money. So now your $2 million, while you're taking your RMDs, goes to $4 million, right? If that's what happens. Let's just say it just goes to $3 million. Maybe you become ultra conservative and we're pulling more money out, yada, yada. So now we're at $3 million. And now we went from 63 to 73. Now we're 73 to 83, taking over 6%. What is 6% times 3 million, Randy?
That's a bunch. That's 100,000, isn't it?
180,000.
Yeah.
$180,000 added to your $120,000 income, or added to your $60,000 income.
Oh, boy.
You got IRMA for the rest of your life. And this is why the 5 critical retirement pillars out there, that's my third one, is tax planning. Most advisors are deer in the headlights. They can't help you with tax planning. It's like, go to your CPA, or hey, go to Zinnia. We do tax planning. Your CPAs do not do the tax planning that we do. They do your bookkeeping, they do your accounting, all that kind of stuff. Sometimes they'll charge you more to do tax loss harvesting. No, we'll do tax loss harvesting for free. We'll create your tax plan at no cost, because do we want to deal with ugly IRMA for the rest of our lives, especially if you live to 90, 95? Some of you out there, a lot of you have longevity. Some of you have more longevity than you actually realize, right? And so not only does that hurt you, but that hurts your surviving spouse, because taxes, go up higher when somebody passes, right? You lose income, you lose a Social Security check, and your taxes go up because your standard deduction gets cut to half. And then when that second spouse passes, and then it goes to your kids, they got to deal with the tax bill. Right. And then they got to cash out those IRAs over 10 years. So RMDs is a big season of life. And we want to try to work with you before you hit that RMD season so we can start figuring out your tax plan. And if you're in the RMD season, we still try to help you figure out your tax plan. It just be a little bit different than the pre-RMD season of age 73. So if you have an IRA, 401k, 403b, 457, TIA, CREF, whatever you got, that is you. I'm talking to you. Come see us. We want to help you with your tax plan. We want to make sure you get RMDs right. And we actually want you to try to pay less taxes in the future by eliminating some of these RMDs, because we can eliminate RMDs, which is awesome. And I wish I would have done it 20 years ago, but we started working on it 10 years ago. So moving forward, that's where we're at.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.